Okay, the next part of this series now, we're going to talk about sources of funding that a company has. And basically we're talking about the long-term sources of funding that a company has. And these are all found on the balance sheet of a company. And the long-term sources of financing now are bonds, corporate debt, preferred stock, which is a different class than common stock, but preferred stock, common stock, and retained earnings. Each one of these now we'll separate out, we'll talk about what they are, some characteristics of them, things of that nature. And for each of these now, I want to show you how to do what's called valuation. How do you find the value of bonds, preferred, and common? Now, you'll remember that now that equity is often referred to as common stock plus retained earnings. These two things added up now. This represents the owner's investment in the company. And as such, we're going to learn how a company goes about raising this kind of money and kind of what it is. Common stock is sometimes referred to as external capital. That is, they go outside the company, they sell a new issue of common stock, and they get equity capital that way. Retained earnings is often referred to as internal equity. This is money now that the owners of the company didn't pay themselves in dividends, but rather retained in the firm. And you recall from an earlier series now, there's only two things a company can do with its earnings: paid in dividends or retain it in the firm. And there's only two things you can really do with retained earnings. That's either pay off the debt or go out and buy some more assets. So these two things will get some attention, but also preferred stock and bonds. One of the things I'm going to teach you in a future video here is how to find the value of a bond, how to find the value of preferred stock and common stock. And technically what we're talking about, when we talk about finding value, we're talking about finding the intrinsic value of an asset. And the intrinsic value is what's the true value of the asset. As an investor, intrinsic value tells you the most you're willing to pay for the asset. Okay? Now, to find intrinsic value, it's the same approach on all assets. For bonds, stocks, businesses, somebody's economic life in court. The basic premise of valuation is that the value of an asset today is the present value of all future cash flows. The past is irrelevant. The only cash flows that are relevant are future cash flows. Find their present value, that is, value everything at T0, and that's going to give you the intrinsic value of the asset. And when I show you bonds and preferreds and common, again, you're going to see that come into play, and we'll talk about it again then, is that the value of the asset today, the present value of all the future cash flows. And there's a couple of things I want you to understand about a corporate financial manager. What basically drives you is what's called the normative objective function of the financial manager, which we talked about in a previous video. The normative objective function of a financial manager now is to maximize shareholder wealth given some level of risk. Now, shareholder wealth, that's the same thing as saying the value of the firm or the price of the stock in the market. That function, what we're about when we talk about a normative objective function now, that's only about common stockholders, the owners of the company. And indeed, as a financial manager, we want to maximize the wealth of the shareholders, the common shareholders, the owners of the company. At the same time, you have to recognize now that as a financial manager, you have what's called a fiduciary duty. Now, a fiduciary duty means that you are in control of something of value that belongs to someone else. A fiduciary duty means that you owe them care with the management of those assets, of that money or whatever it is. And as a fiduciary duty now, you owe a fiduciary duty to the stakeholders of the company, the bondholders, the preferred stockholders, the short-term creditors. You can't recklessly manage the company in a way that destroys the value of their securities. You owe them a fiduciary duty. And again, there's a little bit of a conflict, but not really much. But you owe a fiduciary duty to the stakeholders of the company, not the owners, not the common stockholders, but the stakeholders, the bondholders, the preferred stockholders, and the short-term creditors of the company. You owe them a fiduciary duty. To the owners of the company, to the common shareholders of the company now, what you try to do is maximize their wealth. You try to live up to the normative objective function of financial management.